Hey everybody, what's up? We are back with another stock analysis, and today we'll be looking at SiriusXM or SIRI. So this stock has kind of been like a long-term holder's nightmare and a swing trader's dream, where it is down a lot, but it also has these massive events where the stock price just explodes every once in a while. And that has happened a few times now. The actual company is based around music and music services, playing music, but still a very high market cap considering how much its stock price has fallen. So definitely an interesting company to get into. So we will be looking through the financials today, as well as everything else that I normally do, valuations, a little bit in the earnings, as well as their chart itself. So if you're interested, make sure to subscribe. I make these videos every single day, and let's get into SiriusXM. All right, so getting into SiriusXM, pretty small description here, but basically audio entertainment. They also have Pandora as well, which honestly, I feel like not too many people use Pandora anymore. I feel like I haven't heard anything about it since like 2012 or something. But anyway, number of subscribers in thousands has been very slightly on the decline. Or actually, I should say, end of 2024, they had 33.2 million. They're expecting to lose almost a million subscribers over the next year. I don't really understand why they would even estimate that when it's just going to be that bad. Average revenue per user is also expected to go down over the next year from 15.21 to 15.12. Again, there should probably be direct steps being taken by the company to specifically change this. Now, obviously, there's most likely very large things that need to be done for this to happen, and they do have to give out accurate estimates. But at the same time, there's got to be things you could do. There has to be options or things that you could invest into to improve your own situation. But anyway, fairly negative outlook based on the industry metrics here. So moving on. Market cap, like I said, this is still a fairly large company, which if we come in here and look up SIRI, we can see their stock has fallen a lot from where it used to be. I know it looked like, oh, they're in a middle range here, but you zoom out to where it was in the 90s and early 2000, and they are nowhere near where their valuation used to be, which I do understand. This is mostly a radio company, and radio really just obviously every car has some kind of radio capability and a lot of people still use it, but at the same time it's very much like if you're listening to music in your car, most people use Spotify or Apple Music or whatever, something like that. Not many people use Sirius XM as far as I personally know. Living in the United States my whole life, I think I've heard of maybe two people having it in my whole life, and one of them was someone who bought a car where it automatically came with it. So overall, I feel like there's just not a lot of demand for their product. But this is one thing I'm talking about where their stock will randomly just explode upwards 40-50% in a few days. There was a day here where they saw a high of 81 and a low of 59. If we zoom out a little bit, we see that there's a pattern of just explosive movements here. Now, to be fair, the last couple of years, if I could get my chart right, since I shouldn't even say last couple of years, the last decade and a half for them has been fairly solid up until right around COVID, where it was essentially the final bolt in the casket or whatever the saying is, where basically they're kind of falling off where it is. And this is where the time comes around to where we really see how this is a swing trader stock. If we go to the daily chart here, we could really see it. For the longest time, it basically just bounced up and down within one range here and then had a huge drop off followed by a huge run up, a few more bounces. So overall, this is definitely a swing trader stock. If you're long-term holding this, I think there is a ton of uncertainty. And honestly, it does not look good for the long-term aspect of the stock, at least in my opinion. But anyway, getting back into it, 8.7 billion market cap, 4% dividend, which honestly, I am shocked that they still have a dividend at this point and that it is so high. If we go back to the chart one more time, we can see, at least over the past few years, what's been going on with their dividends. So it looks like 1 cent per share, although adjusted to be 13 per share. Oh, this is with the dividend. Okay. So 13 cents per share there, 22 cents per share there, 26 cents per share, and the most recent one is 27. So they are increasing their dividend in a time where their stock price is massively suffering and their overall business model, at least from what I saw with these industry metrics, is declining by a fairly significant amount. They lost 600,000 subscribers in 2024. So that's something very major. And they're estimating to lose another 600,000 in 2025. So there's got to be something done here to fix that. And we'll just have to wait and see what happens. Target price at 23, long-term growth rate at positive 37%, which honestly shocks me because how is that going to happen? I'm not really sure. But anyway, we're at 25 right now, so that's actually a little bit low off of the target price, looking at a little bit of a downside there. Moving on to their growth summary. Short term, very negative. Long term, we do have positives, but they are very low numbers, to be fair. So I would say overall, the outlook for this company, just based on this, is negative. Again, those long term numbers are positive, to be fair, but at the same time, 7% growth over 10 years per year isn't that bad, but just considering how much the company is also projected to decline in that time, will that 7% actually happen? I'm not so sure. And I feel like investors are not so sure of that either. But anyway, we will finally get into the financials. I think I talked a little bit more than usual for that first part this time, but going into fiscal years, I think we'll have 2024 and we will. So they saw 8.6, I'm going to say billion, has to be billion in revenue. And yes, it is. Okay, so 8.6 billion in revenue. They are actually close to the higher end of their revenue, which to me at least is kind of surprising. I'm actually going to zoom out a lot farther and just see if it used to be much higher because I'm not so sure. Okay, so if we zoom back far enough, it actually just goes right to zero. So I'm assuming they only went public in the early 2000s here. But anyway, moving on. Going to go back to the 15 here. That seems to be working well for me. So they are near their all-time high in sales, which is, to me, at the very least, surprising because I feel like again, they're losing a ton of customers. Their revenue per user is projected to go down. So these things, I feel like their sales should be dropping a lot, and they are down from their all-time high, but not a lot. And let's just look. So their profitability is staying fairly consistent, and actually they have just about the same operating income as last year, despite having just about 250 million less in overall sales. If we look at net income, though, their net income was very negative compared to last year. But again, even their, obviously 2024 was very rough with their net income, but even last year was fairly consistent to where their sales used to be. However, that also means that there was a massive decrease in profitability because their sales used to be much lower than they are now. And now they're sitting here at 700 million last or 2023 net income compared to 700 million 2016 net income, where they had almost 4 billion less in sales. So overall, profitability is just down the drain with this company. Sales do look okay, though. I can't really say that the sales have been bad, but they do look okay. Looking at the total shares, they are going down and actually going down a lot, at least since 2019. That was the last time we saw some increases, but they have been going down a lot. They're now down below 400 million shares at 338 currently. And if we look, we haven't seen them have that many shares since before 2010. So could be very good here. We'll have to wait and see if this will really pay off in the future with them repurchasing so many shares. But anyway, moving on to the balance sheet, let's see what's going on. So 162, hopefully million, and yes, it is, in cash. Now, okay, here's the issue that I see right here, and I was kind of expecting to see it, but boy, is that rough. They have $10 billion in long-term debt, as well as another 100 million in short-term, but $10 billion in long-term debt, and it has only been going up basically every single year for the past decade. That is terrible. Now, to be fair, they do have very positive equity, so I don't know how that will affect their debt to equity ratio, but we'll have to see. But even still, 10 billion in debt compared to 160 million in cash and 27 million in total assets is rough. And also, most of their assets are intangibles, and most of them actually were gained just in the past 2 years. I don't know exactly what the event was that happened with them that just let them gain 20 billion almost in intangible assets in 1 year. But if somebody does know the answer to that, please let me know, because I'd be very interested to see why that occurred. But anyway, so assets have seen very large increases over the past 2 years, going from 10 billion to 27 billion. Now, has this helped their sales? Not really, but hopefully it will in the near future. Hopefully they just haven't been able to fully capitalize on those massive amounts of intangibles that they have. So that is kind of the ideal situation there. But again, 10 billion in debt for this company, that is more than their entire market cap. I think I said earlier they're at 8 billion. And yeah, 8.7 billion market cap, $10 billion in debt. That is pretty rough, I would say. But we'll see later on in the ratio analysis how it's actually looking. But overall, it's pretty rough. Cash flows operating looks fairly normal. We are down a little bit from the highs seen in 2019 and 2020, but overall they are still consistently positive, which is good. However, we're also seeing 5 straight years of declines in operating cash flow. So definitely an issue there. Hopefully they can turn that around. Again, we need to see some financial improvements from the company if they want to see long-term value added to their stock price. So overall, they're consistently positive, which is something to say, but also they need to really focus on growth. Anyway, some acquisitions happening a couple of years ago, nothing else major really in investing activities. You could really see those stock repurchases in here, though. A ton of money, billions of dollars, has been put into stock repurchases, which is awesome. And it's going to very much help this company when they can regain the profitability and the value that they had in the past. And when that does happen, their stock price is going to be much higher than genuinely ever before, because they repurchase so many shares. There's so much less of a supply that they will most likely add a ton of value. Next, free cash flow. Again, consistently positive, but very much on the lower end of what we've seen for the past 10 years. So not great overall, but also at least it's still positive, bare minimum. That is still an okay thing to see. And now moving on to the ratio analysis. So we should see a fairly steady decline in profitability here. Gross margin below the 5-year average, and we did used to see slightly higher numbers. We're at 41% currently. Operating margin is slightly below the 5-year average, and for this, we definitely used to see much higher numbers, 30% in 2016. 2020, we were at 23%, so slightly lower than then. And then net margin is where we have really been taking a hit. 5-year average is at 3.9 now, and they had a negative 19% net margin. So overall, that is not great at all. They used to be consistently above 10%, and now they are just completely through that. It is, once again, not looking very good for their profitability. That is the biggest issue here. So moving along, debt to equity is okay, is pretty high. I will say that. However, because they have so much equity, which I believe is just from decades of retained earnings, let me look actually what their equity is mostly made up of. So, okay, their main amount of equity is their retained earnings, which should be negative. So this has to just be losses then. If I'm reading that correctly. I could be confusing myself right now, but honestly, I just had a 3-hour long class, so I'm not 100% sure. But I'm pretty sure retained earnings are supposed to be negative, so that could explain their equity situation there. But either way, they have a ton of debt. 92% is on the higher end for their total. Or wait, where's total debt to equity? Total debt to equity, 94%. Sorry, I couldn't see it. Is still on the higher end, and just compared to their cash situation, it is also very high. So overall, debt situation is not great. So anyways, moving on, we are going to check out the most recent earnings report and see what is going on there. So we have a metrics recap. Wonderful. So let's see what is going on here. So revenue within estimates, Pandora revenue beating estimates. And honestly, Pandora having a revenue of 568 million just seems insane to me. I feel like I have not heard of that in a decade. So the fact that so many people still use it is very surprising to me. But if they're making that much money off of it, good for them, of course. Free cash flow beating estimates by a fairly significant amount, actually, just about almost 40 million. Um, Net ads, this is how many users they gained. 70K more than estimates, which is good. Or sorry, estimates were 130K and they gained 70K and also lost 100,000 in quarter three. So not great overall, just as a whole, does not look great there. Total subscribers came in slightly below estimates. Other than that, churn was a little bit lower. I believe that's just how often they gain and lose subscribers is their churn percentage, but I'm not exactly sure. Other than that, average revenue per user did come in significantly higher than estimates, which is a good thing. And other than that, I'm assuming this is streams, revenue per 1,000 streams came in slightly below the FactSet estimate. So I would say this is mostly negative. However, overall, pretty mixed. I would say the net ads is definitely the important thing to see here, and they missed that by a lot, 60,000 less than expected. So not great. Not really that bad either, though. I mean, average revenue per user coming in above is really solid. So I think that kind of picks up the rest of the sort of lackluster report. But anyway, let's see if we have anything else. Full year operating and financial results. Let's see if there's anything too crazy in here. And no, this is just a thing that says that they reported. So let's see what is going on here. And we can see this should be the actual information. And of course it is not. But fiscal year guidance 2025, we do have some things here. Reaffirmed EBITDA of around 2.6 billion, which comes within the estimates. Revenue 8.5, slightly below estimates, but overall it is in line with what we're supposed to be seeing. And cash flow of 1.15 billion, which if we look back onto their cash flow statement, we can see 1.15 is higher than what it is in 2024. So hopefully they can obtain those numbers and actually do that. Quarter four EPS saw a pretty large beat. Well, not large, but revenue saw a fairly decent beat as well. And then fiscal year revenue came in above guidance. So overall, can't really complain there. I mean, they did beat their yearly guidance and then reaffirmed their 2025 guidance. So I would say that is overall positive. Let's see what that did to the stock price. So very positive off of that last report. We do see that fairly significant EPS beat as well as revenue coming in slightly over. And they did go up a fair bit since then, probably about 15%, I would say. Let me actually make sure of that. So this is the opening of when they earnings came out, and they are up 18% since then, just about. So overall perceived as a very good report. I would say it was good mostly. There were some negatives in there, but overall it was pretty solid. This company needs a very large catalyst or just a very long line of very positive earnings reports in order to turn around what has been going on with them. Their valuation is nowhere near where it used to be. They just went through a reverse split a few months ago, and it doesn't look great for their long-term outlook, at least in my opinion. They're projecting themselves to lose hundreds of thousands more subscribers over the next year. And again, just based on my own personal experience, I just never hear anything about this, and I'm in the US where they mainly operate. If we look at the geographic revenue, I'd imagine it is almost entirely US, although I'm not actually sure. And yeah, 100% United States. I've lived here my whole life and almost never hear about this or anybody using it. So just from my own personal kind of bias, I don't really think it's as relevant as maybe it used to be, but overall, that's all I have. I would do a valuation. However, they currently have a negative EPS, and it just wouldn't really work out too well with valuing them, just based on the way that I would do it. So if we look here, when I put them in, their EPS is negative, which any number I put in down here will just return a negative value. So either way, the valuation wouldn't work too well. But what I can do here is go with what their projected PE ratio is going to be, or what the projected EPS is going to be. And let's actually see. So this is for the next year and then the year after. And currently, if we just look at what these competitors are showing, they are actually much, much higher than all of them. So overall, it's still just going to project a lot of downside, but I'll put the numbers in anyway. So 8.43, let's plug that in and show what we're seeing here. So this is in the broadcasting sector as a whole. So we're looking at 4.73 and 4.91. Let's plug that in and 4.91. And we get an average PE ratio of 4.82. They have a PE ratio of, oops, I put the wrong number in. So their PE ratio is supposed to be 8.43. So let's put that in here. And if we look, where's it going? Oh, so sorry. I seem to have messed up my own thing here. But anyway, okay. Let me redo that quick. 4.73, 4.91, 4.73, 4.91. So assuming that their PE ratio isn't going to be negative, and let's just say that we go with their next year estimated EPS, which if we look back up here, we can see the next estimated EPS, which would be the next quarter at 0.66. So actually, that would give a fairly solid PE. I'm trying to think. I can use fiscal year and go with 308, which is just all of them added together. Or I can just go with the next one. I feel like fiscal year would probably work out better for me. So we'll do that. So 3.08 gives a PE of 8.38, which is roughly what that last estimate was, giving us a valuation of 14.85 with a 40% downside. So overall, doing the competitor comparison here, it is again fairly negative. Of course, do your own research on this, make your own observations and assumptions. This is just a method that I like to use occasionally. And again, they currently have negative EPS, so my own method that I normally do doesn't really work with the company. But just based on these estimates that I've shown, it does have a fairly significant downside. But other than that, that is all I have for SiriusXM today. So thank you so much for watching. Hope you enjoyed. Hope you learned something. Make sure to subscribe if you haven't, and I will see everybody in the next video.